Google just reported earnings and the stock is down over 6.7% in the after hours, even though the numbers weren't pretty bad. They did beat on EPS. Google Cloud wasn't bad at all. They did grow on it and everything looks fine. But many of you are wondering why the stock is down pretty close to 7% in the after hours. This is why I decided to do a very short video to review the earnings of Google and give you my updated upside potential or valuation models on the stock to see that if we do buy the dip on Google today around the $141, what kind of upside potential and future returns we could expect. Now, in terms of Google stock itself, it's been sitting pretty close to all-time high, and it has now reversed pretty close to $141 per share. Now, in terms of the numbers, they did miss on revenues a little bit, a very tiny miss, 86.31 versus 85.33. I mean, a very tiny miss. EPS earnings, which is very important. They got $1.64 versus $1.59. So they did beat on earnings. Everything looked pretty good. Google Cloud, 9.19 billion versus 8.94 billion. I mean, amazing numbers. You could see at this chart I found on Twitter. This is of Google's Cloud, and it's grew over 37% 4-year CAGR on Google Cloud. And profitability has been improving for Google Cloud. If you look at profitability, Google services did well in terms of operating income. Google Cloud was losing money in 2022. Now it's making $864 million. This is a massive, massive improvement. Now, a lot of smart people I know, they claim that Google is maybe taking, the expenses from Google Cloud and they're putting it into Alphabet level activities. This is why you went from 639 million loss to 3 billion of loss, which in reality, it could be that Google Cloud is still unprofitable, but the way they do the accounting, they're putting it in Alphabet level activities. I'm not sure if this is true or not. It's very hard to know what's really in Alphabet level activities. But so far, I mean, looking at the filings, Google Cloud has been growing revenues and profitability on the surface has been improving. So everything looks good. Yet if you read the headlines on CNBC, you would see that Google went down mainly because of disappointing Google ad revenue. Now, the ad revenues, they really haven't missed by such a huge margin. I mean, 9.2 versus 9.21 expected. I mean, big deal, And the stock still went down pretty close to 7% in the after hours. Now, the question is, why is the stock reacting this way? Why is Google going down despite the numbers being fine? And in my opinion, it's because Google and many of the mega cap stocks are getting pretty close to being priced to perfection. I know it doesn't seem this way, and every stock is not going to be in video, but most of the time, whenever you have a stock that's priced to perfection and the stock rallied into earnings, you have high expectations. Any tiny miss, even pennies, can cause a different perception and can cause massive moves to the downside. And you have the opposite is true. Whenever we had the October low in 2022, we had very low expectations. Any little beat on any good news on earnings could cause 10, 20, 30% moves in many of the stocks. And this is why we ultimately bottomed from low expectations. But a lot of people are entering this season with high expectations with Google and a lot of the Magnificent Sevens sitting pretty close to all-time high. So this is what it is in my opinion, and I'm going to give you my valuation model on Google. Even though if you look at Google, it seems pretty close to the mean multiple. The mean is 24 times earnings, and now Google is trading pretty close to 24 times earnings, a little bit higher than that, but pretty close to 24 times. And this has been the mean over the last 10 years for Google. Even though Google was growing a little bit more than it is growing right now, yet it's still trading at the same multiple. But this is a very fair multiple. Now, I'm going to give you my very quick and fair valuation model, and I think you guys can agree with me that it's fair. Now, in terms of revenue growth, they grew around 10% on currency neutral in 2023. So I just use the 10% for the next 4 years from 2025, 2028, even 2024. So the next 5 years. And I think this is fair. I would not expect Google's revenue to accelerate. It might even go down if we have a bad macroeconomic environment. If the Fed fails to cut rate, ad revenue is ultimately going to suffer on advertising and a lot of the cyclical industries. So again, 10% could be high. It could be 8 or 7%. Because the trend is lower. It grew 13% before 2023 and now it's 10%. So I kept it at 10%. In terms of net income margins, 24%, I kept it 24%. Now it could be a little bit higher if Google Cloud becomes extremely profitable, and Google Cloud's profitability has been improving. but they have been losing money in different areas. So I kept it at 24%. In terms of a PE ratio, because a lot of you talk about the AI stuff, how AI is going to help Google, and I am bullish on Google. And I did many videos when it was $100 and when it was to $85, and I said the stock looks like an amazing buying opportunity. But I have to change my mind if the price is no longer justifying the underlying fundamentals. But I did put a PE ratio around 25 times earnings. The current PE ratio is pretty close to 24. So I just kept it a very fair multiple of 25, even though Google could trade between 20 to 22 times. So even using a very high estimate, in my opinion, of 25 times earnings, the upside on Google from this price is around 61% on the upside, or 10% return every single year for the next 5 years. Now, this is not bad at all if this is what you're looking for. I haven't put a dividend. This is a buyback yield. So the buyback's around 1 to 2% of the market cap. For Google, I put in 1.5%. But in total, you will get a 10% CAGR over the next 5 years. Many people are happy with that, and this is not a bad return at all. Now, for me personally, if I want to buy Google with these estimates was 25 times earnings, which I believe is a little bit high. But if I want to double my money over the next 5 years or get 15% CAGR over the next 5 years, I would have to buy Google at $123.84 per share, which is much lower than where it is right now at $141. 123 would be, it would be pretty close to around where it was, in August, September. I'm not sure if we're really going there. But for me personally, I normally don't like to overpay if I'm not owning Google. If you own Google below $120 cost basis, I think you will likely have an amazing CAGR over the very long term. But if I had to buy Google here, I would personally not do it. It doesn't mean the stock can't go higher. It can't go to 35 times earnings and blow up all rationality. But for me, just analyzing it here in the video, I think this is why you have this reaction, is because Google is priced at a pretty decent multiple, pretty close to perfection. And once you have something that goes wrong, it could cause massive moves to the downside. And this was just my opinion on Google. Very quick update. It was not financial advice. So thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.